The MACD indicator is a popular tool used by traders to identify potential trends in the market. It consists of two lines, the MACD line and the signal line, along with a histogram. The MACD line is calculated by subtracting the 26-day exponential moving average from the 12-day exponential moving average. The signal line is a 9-day exponential moving average of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, indicating a possible uptrend. Conversely, when the MACD line crosses below the signal line, it generates a bearish signal, indicating a possible downtrend. The histogram represents the difference between the MACD line and the signal line. If the histogram is positive, it suggests bullish momentum, and if it's negative, it suggests bearish momentum. Traders often use the MACD indicator to confirm potential buy or sell signals in conjunction with other indicators or price patterns. It can be applied to various timeframes, from short-term to long-term charts, depending on the trader's strategy. The MACD indicator is also useful for identifying divergence, which occurs when the price and the MACD line move in opposite directions. Divergence can be a sign of a potential trend reversal or a continuation of the current trend. Keep in mind that the MACD is not always accurate and should be used in combination with other tools for better confirmation. Overall, the MACD indicator is a valuable tool for traders to analyze market trends and make informed trading decisions.